Welcome to Unit 5.6 Production Planning Part 2. In this section, we will focus on boosting productivity by managing efficiency, quality, and costs effectively. Our learning outcome for this unit includes analyzing, applying, and calculating defect rates. Understanding defect rates is crucial for maintaining high production standards. Defect rate measures the percentage of defective items in a production batch. It helps assess the effectiveness of quality control and production efficiency. For example, if a factory produces 10,000 units and 150 are defective, the defect rate is 1.5%. There are several methods to analyze defect rates, including trend analysis, benchmarking, and root cause analysis. These methods help identify patterns, compare against industry standards, and determine the underlying causes of defects. High defect rates can lead to increased waste and costs. Solutions include implementing quality control measures, automation, and lean manufacturing practices like total quality management, TQM, to reduce defects and improve efficiency. Next, we will analyze, apply, and calculate various productivity rates, including labor productivity, capital productivity, and operating leverage. These metrics are essential for evaluating and improving production efficiency. Productivity rates measure efficiency by comparing output to input. They help evaluate how effectively resources such as labor, machines, or materials are used to produce goods or services. Labor productivity measures how efficiently labor inputs are converted into outputs. For instance, if a factory produces 500 units using 100 hours of labor, the productivity rate is 5 units per hour. Let's calculate labor productivity per worker week and per labor hour. If 800 units are produced per week by 10 workers working 400 hours, the productivity is 80 units per worker per week or 2 units per hour per worker. Capital productivity measures how efficiently capital inputs are converted into outputs. For example, if a factory produces 50,000 units using machinery costing $10 million, the capital productivity is 0.005 units per dollar. There are several ideas to raise productivity, including training, motivation, technology, and management efficiency. It's important to consider the costs of any suggestions to ensure they are feasible and beneficial. Production is the total number of units produced, while productivity is about efficiency. A company can increase productivity even if production remains the same or declines, by optimizing labor and capital costs. Operating leverage measures how a company's operating income changes in response to sales changes. High operating leverage means higher profits with increased sales but greater risk if sales decline. Our next learning outcome is to evaluate and calculate the cost to buy, CTB, and cost to make, CTM. This analysis helps determine the most cost-effective option for production. The make or buy decision involves choosing to produce a product or purchase it from a supplier. It includes both quantitative and qualitative methods, considering factors like core competencies and financial benefits. A straightforward method for make or buy decisions is cost-benefit analysis. If the cost of producing is lower than the supplier's price, it makes sense to manufacture rather than outsource. Consider the example of making your own hoodie. Purchasing costs $600,000, while making costs $360,000. It is cheaper to make, demonstrating the importance of cost analysis in decision-making. Other factors may override quantitative decisions, such as core competencies, product quality, subcontractor reliability, available spare capacity, and whether the decision is irreversible. Cost-benefit analysis for make or buy decisions involves 4 variables: expected sales volume, fixed costs, average variable costs, and price per unit charged by the supplier. Compare CTB and CTM to decide. A firm deciding between buying and making 1,000 garden benches should consider costs. If buying costs $20 per unit and making costs $13 per unit plus $5,000 fixed costs, making is cheaper, saving $2,000. In the example, CTB is $20,000 and CTM is $18,000. Therefore, the firm should make the benches, saving $2,000. This highlights the importance of thorough cost analysis in make or buy decisions.